Welcome to the Money Mentors Podcast.
Hi, I'm Gary Mattson with Mattson Financial Services. With me is Corey Davis, a financial advisor with our firm. And let's face it, things are getting a little bit heated out there. And if you know what's going on politically, there's a lot of questions going out there. There's a lot of thoughts of what's going on with the markets, what the feds are going to do. And really, do we have the competency running our government? A lot to talk about, a lot to think about. And we'll kind of sift through this as we get through this weekend.
You're right, Gary. It has been a political roller coaster over the last few weeks, from questions about the age of the current president to an assassination attempt on a former president. Crazy times, and certainly things feel quite uncertain politically. And we know Wall Street in particular does not like uncertainty. So, Corey, Gary, we may be at record highs right now with this market, but do you see things kind of shifting over these next few months as we lead up to November?
We've been saying, I think, for a while now, since 2008, volatility has entered the market in an unpredictable way. So for us, we plan that volatility is here to stay. It's not something that we like. It's not something the markets like. But when you have something happening in China or Taiwan or, you go North Korea, and we're all seeing these things on real time, we're not getting it secondhand or a day or two later. We're watching it unfold live on TV. These are things that people will react to emotionally. And maybe they should. Maybe they should just take a breath, kind of slow down, and see what the landscape's going to do and the longevity of it. And that's really what we're at right now, is that, yes, the feds have said they're definitely not going to raise rates in September. They might take a price cut, lowering the interest rates. The market immediately priced that in. If you looked at rates out there for borrowing, our bank went down 0.2% on recent loans. So we know that's affected it. It's already priced into the market. But if they don't do that, or actually change that and raise that whole conversation now has changed the direction emotionally to the market, and you're going to see the market take some major dips, positive or negative, in the short term. Again, the idea is it's short term. It's not going to be something that's going to last more than maybe 30, 60 days on the political landscape, and then we get back into our rhythm. The market does not like things that it does not see happening or thought it should happen. Perfect example of this is when we go back to England, and they took the vote if they're going to stay in the European Union or not. And to everybody's surprise, they voted to be out of the union. And the next day, their market fell over 14%. Their sterling pound went down over 14%. And of course, as advisors that we do, we took advantage of that, moved in, bought some of those blue chip dividend paying foreign companies. And over a period of about 16 weeks, held it. And when it came back up, sold it. So again, market opportunity is there, but we want to make sure that we're in the position that you can take advantage of what the market gives.
Yeah, everything that's going on is very emotional out there, but I think what it comes down to, especially with investments, is to take the emotion out of it. We're very big proponents on reacting to what the market is doing, not trying to predict what the market is going to do.
And Corey, how is it for you when you see Gary get giddy about some of these blue light specials when they do occur with this market?
I love it too. I was trained by Gary, so I drink the Kool-Aid too. I get excited as well.
Yeah, if they don't drink the Kool-Aid, we got to have a conversation.
Exactly. Right? That investment philosophy, though, Mattson Financial Services, is so important, especially when there is uncertainty in the market. At the same time, I know a lot of people right now want to take advantage of these market highs and look for those really good gems out there and those opportunities as well. But I know a lot of our listeners probably follow a more traditional investment portfolio, and you might have what's known as that 60-40 portfolio, 60% in stocks, 40% in bonds. But USA Today points out the last few years have not been good for bonds, at least, here and there. 2022, they mentioned in particular, was really rough. But should we consider more or less on that bond side of the portfolio? And is that old 60-40 rule, is it terribly outdated today?
Well, it is in some fashions. Let me give an example. And this is dating a little bit, but it's recent events that kind of shows what can happen. In 2008, when the mortgage industry just fell flat, we had the downsurge in the market. Immediately following that, the bonds for the sewer bonds in Detroit did not have the funds to pay the bondholders.
Ah, yeah, I remember that.
So went bankrupt. Now, people say, well, municipalities don't go bankrupt, and so that's a great investment. Well, no, they do, depending upon the circumstances. In fact, Orange County of New York and Orange County of California, both those counties have failed at one time or another. And so when you look at bonds, they're not always guaranteed. There are risk there. I don't care what bond it is, carry some risk with that. Stocks carry a risk as well. So you really want to look at it from the standpoint of that we want at Matson Financial Services, when it comes to your income, we want that to be guaranteed that the markets, either good or bad, will not take away the opportunity if you have the income that we set up. So we set up your critical income need in a bucket that we know the markets cannot penetrate, change it in a term that we've set it up. And generally, we set that up for 18 months. When you start with us, we're going to put together an income bucket. It's going to last for 18 months that we don't have to do anything to it, and it's going to be there every month. When you require funds, it's going to kick that out. Now, people say to us in our program or sitting with clients is, why is 18 months? Well, we've been doing this for a couple of years now, just over 34 years. In that 34 years, the longest it's taken for our clients' account to get back to even when we've had a market downturn was 18 months. So if that's the longest term it takes us, that's what we're going to do. We're going to plan for that eventuality that's going to happen again. We don't want our client to have negativity when they take money out of their accounts. So if we don't have negativity when you take money out for income flow, and then as markets change over that 18 months or 2 years or whatever's going on, we can refill that bucket from diversified assets. Like it could be stock that did it, it could be a bond, but it could be other assets that we carry like real estate, private equity, hedge funds, even precious metals like gold or silver. So whatever is going on out there, we look at an opportunity to say, okay, we've got this diversified portfolio. Something in the 8 to 9 categories we have is going to make money out there. And we watch the markets and react, like Corey said. And as we do that, we refill the bucket with positive assets. And that way, if you don't have a portfolio that goes negative, basically stays flat or grows, it means it's going to last you longer. Or you can have more income in the future. And that's what we see with our clients today after the recent downturns in the market and coming back up, is that now we have extra money. Our clients are talking about taking additional trips or giving money to their children. Or literally, we've had some clients actually buy out the mortgage of their children because of interest rates being much higher. They're getting a standard rate of return that's pretty good for them, they're happy with. And they've taken that burden away from the children, having this variable mortgage, if you would, that could go up or go down. Everybody wins in that if it's set up correctly. I'm not saying everybody should do that, but again, it should be set up correctly if that's what you want to do. So once again, there's opportunity there in different various degrees, and that's what we're about at Matson Financial Services, is taking advantage of the market, what it offers us, and making sure your portfolio is in the best position throughout it.
Yeah, nobody wants to have a conversation with their advisor that because the markets are down, they need to pull back their income, or because the markets are down, their entire portfolio is down, and now all they have to do is hold on and wait for the markets to come back up. It feels like babysitting in that situation instead of having a good active portfolio manager. So that's why adding those other assets and allow us to always do something and make some type of change to benefit our clients.
Want weekly lessons from your money mentors? Yes. Hit the subscribe button now and listen every weekend on Wood Radio.
The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Fee-based financial planning and investment services are offered by Matson Financial Services, LLC, an SEC-registered investment advisor. Insurance products and services offered through Lakeview Financial Group, LLC, Matson Financial Services, LLC, and Lakeview Financial Group are affiliated. To find out if Matson Financial Services is licensed in your state, please call 800-536-8907.